Ladies and gentlemen, we now will move on to the next session. In this panel session, called A View from the Practitioners, we have two very special guests, one speaker who has flown in all the way from the United States of America and is here with us today in Kuala Lumpur, and the other is none other from a local distinguished pension fund company. I would now like to call upon our moderator once again, Encik Zakaria Osman, to introduce his two panelists and to lead the session. Over to you, Encik Zakaria.
Okay, ladies and gentlemen, we are now in panel session 2 to get some insights from the practitioners to better understand on their journey in setting up Shariah ESG portfolios. These will give valuable guidance to existing clients who are looking into setting up the Shariah portfolios. Ladies and gentlemen, flown all the way from the United States, we have Mr. Scott Klima, Vice President and Chief Investment Officer of Satuna Capital. Interestingly, having read his biodata, apart from being a CFA charter holder, he received his Bachelor of Arts in Asian Studies from Hamilton College in Clinton, New York, and attended the Chinese University of Hong Kong and the Mandarin Training Center in Taipei, Taiwan. So I believe you speak Mandarin. And the first several years of his career, he spent living and working in a variety of Asian countries. And also joining us in this panel session is Mr. Rizal Muhammad Ali, the Vice President, Responsible Investment of Retirement Fund Incorporated, or QUAP, a Brunel University graduate with an LLB honors, a member of Chartered Institute of Islamic Finance Professionals, and a working group committee member of the Institutional Investors Council of Malaysia. Rizal has over 20 years of experience in legal and ESG related work. Thank you very much and welcome again, and thanks for joining us today.
Thank you.
So ladies and gentlemen, and as you can see, up until last year, the asset management industry had been in growth mode, topping US $100 trillion in total assets. But right now, with inflation and rising global conflict, the markets are well below their record highs from late last year. Records also showed that Satuna's global assets under management decreased 6% for the fiscal year, ending at $5.4 billion. Assets managed by its Malaysian subsidiary fell 7% to 286 million ringgit at the same time. Assets managed in ETFs with its European counterparts, however, increased more than 8%. So now, at the back of these numbers, Mr. Klimo, could you please share the performance of Satuna's Shariah compliant ESG funds so far this year?
Sure, I'd be happy to. Obviously, the dominant factor for the year to date in terms of performance and assets has been the overall move of the stock markets. We had quite a negative day in the U.S. markets today following the first returns from the midterm elections. The NASDAQ index was down 2.5%. The S&P 500 was down just over 2%. And so year to date, if we look at those two indices, we're looking at something in the neighborhood of 23% down year to date for the S&P 500 and over 31% down for the NASDAQ and the Russell 1000 growth indices. So if we look in the context of the marketplace, we've seen that the amount of funds have actually held up quite well. So one of the things that we focus on is downside protection. And our founder likes to say that one of the best ways to make money is to not lose money. And so over the cycle, it's obviously easier to have outperformance if you don't have to make up a lot of ground from negative performance in the down years. So year to date, the amount of growth fund is down about 24%. And as I said, that's quite strong relative to, say, the Russell 1000 growth index, which is down over 31%, or the NASDAQ, which is down well over 30%. And so the same is true really across the board for our Shariah compliant funds. That includes the amount of income fund and the amount of developing world fund as well, which focuses on emerging markets investments around the world. And those are are funds that, in addition to Amana Growth, over the past year, these funds are all in the top quartile of performance against their competitors in the United States. And actually, Amana Growth and Amana Income are in the top decile of performance. So they've really done a solid job of providing the downside protection that that we talk about. And I think one final comment that I would make about that is that it's important to note that this performance was achieved despite the fact that these funds also have an ESG mandate, part of the reason that we're here today. And so we do not invest in fossil fuels. And as I'm sure everybody in the audience knows, fossil fuels have been the only sector in the broad market that have provided a positive return this year. And we have no exposure to that. And yet we've still managed to significantly outperform the markets.
Oh, interesting. Okay, you mentioned something about the Amana Growth Fund, and based on the report, it's been ranked as the #1 large growth fund by the U.S. News and World Report magazine. So how does Setuna actually achieve this, and what are the strategies to mitigate all the current market risks, as you mentioned earlier?
I think that the answer to both of those questions is the Islamic or Shariah guidelines that we use in managing the fund. A big part of that is avoiding companies with excessive leverage or too much debt. We have an environment of rapidly rising interest rates, and so companies that do have significant debt positions are going to be experiencing higher interest payments that can have an effect on their earnings. Additionally, one of the big risks that people are considering right now is the risk that we head into recession. And if you are a company with a large debt position, obviously a recessionary environment creates potential financial risks for your business. If all of a sudden demand collapses, how are you going to meet your interest payments and your obligations? And so those are risk factors that the fact that we are not exposed to those risk factors is something that certainly helps in this type of market environment. Another key issue is that of speculation. Obviously, speculation is discouraged, if not outright prohibited, in Islamic investing. And we are very much focused on long-term investments that we hold over the course of the cycle. We are focused on the companies, the operational aspects of these companies, rather than what we think might happen for the quarter, or what are we going to trade because the Federal Reserve might do this. I mean, we go into very great detail on these companies from a fundamental financial perspective and from a fundamental ESG perspective. And when we make investments, it's with certainly the hope, if not quite the expectation, but certainly the hope that we are going to be holding these companies for years, if not decades to come. And I think that's really been a key issue in driving the outperformance of the funds over the years.
So it's more of a long-term strategy to mitigate all those market risks.
It's very much a long-term strategy, and when we talk about market risk, one of the things that we talk about is behavioralism, which I think Keynes referred to as animal spirits, and those sorts of things are difficult to anticipate, and certainly difficult to trade around with any sort of consistent value-added approach. And so we just try to put all of that outside of our consideration and just look at, how is this company doing? Does it have a sustainable competitive advantage? Are we able to identify that advantage? Does it have an excellent management team? Is it well governed? Are their employee relations good? Something that's interesting is, you may have heard Fortune magazine in the United States every year puts out a list of the 100 best companies in the United States. And the way that they determine what is best is by interviewing employees and say, well, how do you like working here? Do you think you're fulfilled? Does the company appreciate your efforts? Questions of this nature. And it's not just listed companies, it's universities and hospitals and things of this nature. But for some inexplicable reason, the companies that appear on that list, the listed companies that appear on that list, have provided about 200 basis points of annualized performance advantage over the markets. And the thing that's strange about this is this phenomenon was first identified, I think it was back in 2010 or 2011. There was an academic paper that was published. And usually when something like that happens, then the phenomenon goes away. It's like, oh, okay, we all know that now. So now we're going to start looking at those companies. But somehow that has persisted. So that aspect, the S aspect of the ESG, which is something that we do look at as well, is very important. And not surprisingly, a large number of the companies that are on that 100 best companies list also populate our portfolios.
Okay, thanks for giving us the global perspective of the development of this market. So I'd like to bring back to the local scene. And as you can see, that what the market is said to have a very challenging one this year, 2021, 2022. Co-op, on the other hand, it has been reported has achieved a record fund size of about 159 billion ringgit as at end 2021. And with the recent launch of Trust 5, I believe it was a few months ago, Co-op is said to be able to realize its vision to grow its growth fund size to 200 billion ringgit by 2025. So my question, I'm not talking about the numbers. I just want to get some insights as to what are basically Co-op's challenges in its journey, because it started as a conventional, then you moved to Shariah compliant, and now you're moving towards the ESG. Would you like to share? I mean, would you like to share it with us in terms of what's the journey like for Co-op?
Yeah, thank you.
Yes.
Yeah, thanks for the question. And thanks for the detailed explanation, Scott. Very useful. So for Co-op, we started our journey way back in 2008. The main challenge we faced back then was lack of awareness by our investing companies. Hence, there was not much that was done in this space. So we took a 6-step approach to overcome this. First is engagement. Second is guidance. Third is set specific time bound of commitments. Fourth is monitoring. Fifth is benchmarking. And sixth is conduct periodic reviews. With regards to engagements, we are an active shareholder. So we engage with our investing companies and we conduct at least 20 engagements in a year. This is in addition to analyst briefings and also attendance at AGMs and EGMs. On guidance, we provide guidance to our investing companies during the engagements. This way, we can gauge their adoption, and also we provide specific guidance on the industry they are in, rather than have a one-size-fits-all approach. So we look at what are the ESG pillars, what are the ESG issues that industry is more exposed to. On expectations, we publish our voting policies and guidelines. This set out clear expectations and also how we will vote at their AGMs and EGMs. So they will know beforehand how we will vote and also what they need to do to meet our expectations. On monitoring, we monitor the adoption of our recommendations. We have a dedicated ESG team with 6 full-time officers. So we monitor our investing companies, and we also monitor the ones that we do engagements, pre-engagements, and also post-engagements to see whether they are able to meet the commitments that they have given us. The fifth is benchmarking. We benchmark our policies against the best industry practice. This includes both local and also abroad. And for review, we constantly review our policies and guidelines, because as we know, ESG is evolving. There's increasing expectations on the standards expected. For example, if I may quote, labor practices that is acceptable, say 3 years ago, might not be acceptable anymore now, especially as more of our investing companies penetrate the global market. Thank you.
Okay, I'm impressed. That's a very comprehensive initiative to basically to move forward in terms of promoting the ESG investments. I mean, by which you're saying that you have got to do into the monitoring, compliance, this kind of thing. Okay, just a simple question out of your answer earlier. It's just that what if your investing company failed to fulfill those requirements? What would you do? I mean, would you withdraw, or how? I mean, just to see where your stand is.
Yeah, that's a very good question, and it's certainly a very practical one that is relevant. So to answer your question, it depends on what are the ESG issues. For example, if they already have something in place, but it needs improvements for them to meet the expectations, then we expect them to give a specific board-approved time-bound commitment. If they do not meet it within the agreed timeline, then we might engage with them further, and we might then choose to pare down our investment or divest. On the divestment, I will touch on it again later. Secondly, if it's a fundamental ESG breach, for example, if it involves governance, if it involves financial statements, if it involves audit issues, then based on the outcome of it, we might choose to divest immediately. But having said that, we feel that as an institutional investor with long-term investment horizon, we are in a good position to push for improvements in their ESG practices. So most of the time, we give them an opportunity to make improvements, because if we were to divest, the issue might not then be addressed, and the minority shareholders might not have the capabilities or the manpower to scrutinize their ESG practices and realize these issues. Thank you.
Okay, so you're saying about the divestment, we'll discuss later. Okay, in terms of the investment policy, do you have this? I mean, of this policy being developed just to fit in, or how do you go about doing that?
Yeah, so the policies are benchmarked against, number one, what our regulators recommend as the best practice. So we take that into consideration, but we might not follow it strictly. We use that to also push for the government agenda. Secondly, we are signatories to the United Nations PRI and also the Malaysian Code for Institutional Investors. So we also benchmark against our commitments under these two codes. And thirdly, based on our own engagement with our investing companies, based on our findings, based on the issues we identified, we incorporate this into our policies and guidelines. A point I would like to highlight here is it's important that you review these policies and guidelines periodically, at least every 2 to 3 years, to make sure that you keep abreast with the latest industry practice.
Oh, okay. That's very thorough. Okay, I'd like to come back to Satuna Capital. Okay, as we know, that Satuna Capital has more than 30 years of experience in value-based investing, and for sure it started with conventional, and now it has started to be known from its Shariah funds, especially the Malaysian subsidiary here in Kuala Lumpur. So let's narrow our focus on our ESG investing and especially Shariah compliant investing. Now, as we know that this ESG investing and Shariah compliant investing shares similar characters, similar features, and they promote the stewardship and societal kind of thing. So based on the success stories of the creation of a Shariah compliant portfolio, maybe Clement, could you please share the journey in setting up how to actually develop or create the Shariah compliant portfolio?
I think that involves a bit of the history of Saturna, and I actually need to make a little bit of an adjustment to what you said. Saturna was not started to manage conventional funds. The reason the firm was founded was specifically in 1989, was specifically to manage the amount of income fund, and it's kind of it's a bit of our what would you call it? I guess origination story of how Saturna came to be. And what happened was that our founder was working in a city in the United States, and a number of Muslim businessmen came to him and said, well, we understand that you're quite a good investment person, and there's really nothing in the marketplace that meets our needs from a religious perspective, and we're wondering if you would be interested in managing a Sharia compliant portfolio. And he responded, well, I'll have to learn what a Sharia compliant portfolio entails. But he went back and studied it, And it turned out that much of what's important in the Islamic guidelines that I was discussing previously aligned very well with his own philosophy about not investing in overly indebted companies, not engaging in speculation or technical trading, but rather, or tactical trading, but rather long-term investment. And so he agreed to manage the fund, and that was why Saturna Capital was started. So the Amana Income Fund was launched in 1989, and the Amana Growth Fund in 1994, and those are to this day the two largest funds for the firm. And some of those businessmen who originally came to him remain on the Amana board up till now as well. So it's been quite a long, just like our investments, it's been a long-term relationship with the people who came to speak with our founder. So as far as launching or creating a Shariah portfolio, the first thing obviously is to understand what the guidelines are, and also to receive guidance from an expert such as a Shariah advisor. So we have a Shariah advisor, of course, Amani, which looks over the holdings that we have in all of the funds and ensures the Shariah compliance of everything that we own. But we've been doing it now for over 3 decades, so we have a pretty good sense of what's going to be acceptable and what won't. And I think that one of the key aspects of building a successful and also a truly compliant portfolio is that it requires active management. We have seen, certainly in the ESG space, we have seen a number of examples of passive funds that have ended up investing in companies that very few people would consider to be ESG. I think S&P 500 launched a passive ESG fund, and it ended up owning handgun companies and things of this nature. So, we have concentrated portfolios, 30 to 50 positions, and we do detailed qualitative analysis, as I mentioned previously, not only of the financials, but also of the ESG and also of the Shariah compliance. And so we really know what these companies are up to across the board and can verify that they are appropriate for their portfolios. And another advantage of that approach is that we often know that a company is planning to engage in some haram activity before they actually start doing it. So that gives us the opportunity to exit. And just like as was being discussed previously, just like a company that breaches ESG guidelines is potentially a candidate for disinvestment, a company that breaches the Shariah guidelines is immediately going to be divested. And so an example that I can provide just from this past year is that Pepsi Cola, which we used to own, they signed a joint venture to make an alcoholic version of one of their soft drinks. And so I was covering the stock and I saw this announcement, oh, we've signed an agreement to do this JV. I was like, well, okay, but we're going to have to sell our stock now. So I really think active management is very, very important. And even, it's things like that are fairly simple. But when you talk about things like speculation, for example, that can be a bit more subjective or more of a judgment call. And if you look at some of the large MSCI Global Islamic Index, for example, or the Dow Jones Islamic Index, you'll find a number of holdings that we would not consider to be appropriate. I hope it's not against regulations for me to have mentioned them and talk about this. But for example, I can't remember exactly which one of it is, but Amazon is a holding in one of those Islamic benchmarks. Well, Amazon owns Whole Foods, and Whole Foods has a very active business selling pork and selling alcohol. So that, to me, is clearly not acceptable, and so we would never hold Amazon in one of our Shariah compliant funds. Tesla is another company that I think is kind of problematic because it seems to me it's almost the height of speculation. For many years they didn't make money, and even though they are profitable now, they're still trading at a multiple that last time I looked, I think it's come down because Elon Musk is selling his Tesla shares to fund Twitter. But the last time I looked, it was 100 times earnings. that's when I look at Ford at 8x earnings, that seems that we're engaging in some speculation about the potential future of Tesla, which I think is unfounded. And so that's a stock that we would also find very problematic. And so the issue of building the Shariah portfolios is to really understand the guidelines, whether you're using debt against assets or debt versus capital, understanding the reason for the accounts receivable restrictions. So for example, in our portfolios, accounts receivable cannot exceed 45% of total assets. And again, it gets back to speculation. If you're providing a product and not getting paid for it, that doesn't seem to be the best arrangement. And then, of course, the sources of haram income, which have to be very closely monitored. And so I think those are really the key focuses. And one of the aspects of the ESG that works so well and is the reason that we decided to adopt a specific ESG mandate for our Sharia compliant funds in 2017 was that it was easy. It was a very easy evolution rather than a revolution to take our Sharia compliant funds and make them ESG, because we'd always been concerned about governance. If you're going to invest in a company for 5, 10, or even 20 years, governance is important. And so that's always been a key focus. The social aspect, as I was discussing earlier with regard to employee relations and various issues of that nature, have always been important. The environmental, we had to make a bit of an adjustment there. I mean, we were not precluded from investing in fossil fuels previously, but we decided that was, number one, it was a worthwhile sacrifice, for lack of a better word, to make, but also not really keen on the long-term outlook for the fossil fuel industry. I mean, it's had a great year, obviously, in 2022 because of a number of exogenous events. But do I think that's going to continue for the remainder of the decade? Personally, I doubt it. So it was a very easy transition for us to make, and was also very well aligned with our own investment philosophy.
Okay, I mean, I would say that it is very much in terms of the Sharia requirements, Sharia parameters, Sharia. I know all those because Babajita, you're saying that you'll be referring to your Sharia advisors as well as Sharia guidelines, and I believe, being in the market, one of the challenges of setting up a Sharia portfolio is that many investors will still think that Islamic investments tend to underperform their conventional counterparts. So although studies have proven that otherwise, but how would you educate people? Would have to think that, oh no, this is Sharia compliant. I think the performance is much lower than the conventional. So or even the ESG. So how do you actually build the trust of your investors in this?
Yeah, I mean, the things that people believe can sometimes be perplexing, but I think the way that we do it is through long-term performance, and that is recognized by people who are doing dispassionate reviews of that performance relative to an appropriate group of competitors. And so, as you mentioned, U.S. News and World Report has named the Amana Growth Fund as the #1 growth fund in the United States. Investors Business Daily this year named it to its list of best mutual funds, best growth funds, and just best overall funds. And of course, Morningstar, which I'm not sure how active that is reviewed or looked at in Malaysia, but in the United States, it's quite important. And in Morningstar, the fund has a 5-star rating and has significantly outperformed the category over any time period, whether you look at 1 year, 3 year, 5 year, 10 year, 15 year, since inception. The Amana Growth Fund since inception has returned approximately 14% annualized, while the S&P 500 has returned roughly 12%. So if you take that 2% gap over 28 years, that adds up to a lot. That's which is, not an unreasonable time horizon if you're looking at investing for retirement, for example. But that's going to add up to a significant number. And interestingly, not only do you sometimes hear, what you're talking about with regard to Islamic investing, but of course we also hear it with regard to ESG investing, that, well, you can do good, but you can't do well. But interestingly, since 2017, when we adopted the ESG mandate, our fund has returned 16% annualized, while the S&P 500 is still around that 11 to 12 range. So with the ESG mandate, the performance gap over the past 5 years has even widened. So I think you just have to put up the numbers. You do what you can to publicize and to market and to educate. You hope that people like U.S. News and Investors Business Daily and Morningstar recognize that, and it has been the case. I mean, despite the fact that markets have been as weak as they have been in 2022, and despite the fact that active management is generally seeing outflows, while passive management has been dominating the inflows, we have had positive inflows this year. So I think the marketplace does recognize it. And if I may, just one final point I'll make on this is that I think the fact that it's recognized in the marketplace is quite clearly indicated by the fact that something in the neighborhood of 50% of our investors in the Amana funds aren't even Muslim. So the Shariah concepts to them, they may not even really know what they are, to be honest. But what they're focused on isn't that. They're focused on the performance of the funds and the returns that they have provided over the years.
Thank you, Scott. Okay, I'd like to come back to Kwok. So you mentioned earlier in terms of your requirement, in terms of your monitoring process of this kind of thing. And again, it's back to what we mentioned earlier, there is a sort of a limited number of stocks that comply with ESG Shariah. So do you see that this will be the major obstacle for Kwok to increase the investment size? I mean, the limited number of ESG Shariah compliance.
Yeah, thanks. Firstly, I would like to highlight that not all government-linked investment companies have Shariah mandates. However, studies show that most of the subscribers to ESG Shariah do it to meet our ESG requirements rather than Shariah requirements. Hence, organizations that has integrated ESG into our investment decision-making process would be looking out for ESG Shariah investments. But there is a shortage of global supply of ESG investments, and the current supply of ESG debt issuance is short of these expectations and demand. Hence, there is opportunity for green and sustainability sukuk to bridge the gap. But having said that, as Islamic finance and Shariah share common principles and complementary investment approaches, sukuk approach will provide an alternative source of funding, for example, for sustainable development projects. The UK IFC estimates that green and sustainability sukuk could raise up to between 30 to 50 billion of capital to be allocated to SDGs by 2025. Hence, there is a shortage of supply of ESG Shariah. And as more and more asset owners integrate ESG, they will be looking out for this. But whether it's a major obstacle, it really depends on the mandate that the JLICs are operating in. Thanks.
Okay, so very, how shall I say, very good prospect in 2025 billion increment. And again, let's go back to the industry. So while the global industry observers are predicting significant growth, as you mentioned earlier, by 2025 should be an increment, then they have conducted a survey saying that 72% of those surveyed believe that Islamic finance market has yet to meet the demand for ESG and Shariah compliant funds, even though there is an expectation of a growing. As mentioned earlier, there's an expectation of growing, but there is still lacking behind. So do you see, and based on what's been stated in the report, one of the main issues that remains for all this while is that the lack of global standardization. So do you see that the lack of standardization as a challenge? Because this jurisdiction will use this prediction. Then so how do you see that? Do you see that as a challenge, and how do you overcome that? How do you do that?
Yeah, thank you. It is certainly a challenge in the sense that it will be good to have a standard that is applied across the boundaries. But how we overcome that is we have ESG focused officers who are able to scrutinize the practices better. And through our engagements, we are able to convey our expectations that will be based on best industry practices. Hence, if even though they adopt different practices, we're able to look at them specifically, individually, as part of our investment papers and make the necessary calls. But that's a good point that is raised because as with ESG, with the threat of greenwashing, we also have to make sure that the Shariah investments are truly Shariah compliant across the jurisdictions.
Okay. I think before I move on to the next question, I would like to share this question from the floor, asking, with the current focus on ESG, do you see any increase in Shariah investing both locally and globally? So maybe Scott, maybe you can give your thought on that. Do you see that there will be an increment in terms of Shariah investing?
I don't think that really has an effect in the United States. I can't really speak to other jurisdictions. I mean, we are active in Europe, and I don't think in either of those two places, I don't think that ESG in and of itself would have any effect on the Shariah investing. That's kind of a very specific marketplace that you're focusing on, and although we do have a large percentage of investors who are not focused on the Shariah aspects, I'm not sure that they're all that focused on the ESG aspects either. They're really just focused on the performance aspects, and that's what's attracted them to the fund.
Okay. What about Rizal? Do you have any?
If I can, thanks. If I can chip in, we're certainly looking out for asset owners are looking out for more ESG investments. For example, as more asset owners give the pledge to be carbon neutral by 2050, we want to reduce our finance emissions. So with increase in demand for ESG, at least in this region, there's also increase in ESG Shariah. As I mentioned earlier, both Shariah and also sustainability shares common and complementary investment approaches. So Shariah will provide an alternative source of investments for investors that has integrated ESG. So I think moving forward, as what's happening now, the demand for Shariah is also coming from investors that has integrated ESG, and this trend will keep on rising. And specifically, as you get more signatories, for example, to the UNPRI and also the Malaysian Code of Institutional Investors, we will be looking out for more Shariah to complement our ESG investments. Thanks.
Okay, thank you very much. Okay, coming back to the ESG criteria, because I believe, as what Rizal was saying, that FOP has actually based on a few guidelines to best practices kind of thing. What about Setuna? What are the criteria? How do you actually define the ESG criteria in Setuna practice?
We have one of the things that we thought was important from the beginning was not to simply rely upon the ratings agencies. I'm sure you've all read about discrepancies in judgment among the ratings agencies. You can have MSCI say one thing and Sustainalytics say something else, and so we felt it was important to have our own system for grading the ESG metrics, for the quantitative aspect of grading the ESG metrics. And so we do have to pull the data from somewhere. We're not aggregating this data ourselves, so we use Refinitiv, which is a London Stock Exchange company, as our source of data. But we've created our own set of metrics under each of the silos, the environmental, social, and governance silo. And each of those sets of metrics are adjusted for the industry that we're talking about. So for example, it makes very little sense to compare the carbon emissions of an airline against the carbon emissions of a bank. So you need to make it appropriate to the industry that you're discussing. And so part of that is our own judgment about how we should weight various issues for these industries. And part of it we kind of look at the data that's available. So for example, if there's a specific metric that every single company in an industry is reporting, we'll take the view that, well, that's probably a relevant metric and we should include that. If there's something that only 10% are reporting, well, then maybe it's not something. I mean, we'll look at it. Maybe it's something that's important. You should be reporting it, and we'll give extra points to those who are and demerit those who aren't. But we'll have a look and see if it really matters, because you can keep adding metrics ad infinitum until you have a spreadsheet with 10,000 lines to try to come up with these scores. So you do have to establish some areas of focus, create a weighting that's relevant in an industry specific. And even to a certain extent in a geographically specific region. So for example, if we're looking at governance and board representation, Japanese or Korean companies are not going to do very well on gender diversity in their boards. Obviously, European and to a lesser extent US companies will do much better in that regard. And so if you're looking at coming up with a score for Japan or Korea, you need to take that into account. And so this illustrates one of the problems of quantitative scoring systems is I've already mentioned the discrepancy that you can have among different companies, but also just the discrepancy that you can have among industries or geographies. We try to avoid. I mean, there are certain industries that we say, okay, you're just out. I mean, there is a negative screening element to ESG, just like there is to Shariah. So we don't, there is no such thing as the world's best tobacco company. I mean, they're all out. But other areas can be more gray, less black and white. And so that's really where it comes into the qualitative aspect that I was discussing previously. So our quantitative screening system, I guess to wrap it up, we have three main reasons for doing it. The first one is, as I mentioned, the discrepancy among existing ratings. So we want to understand how it works. And we also want to track how do our scores correlate with performance, because that would be an interesting thing to know after 3 or 5 years, if there is a correlation there. And we also gives us the opportunity to have iterations and improvements as we discuss, and to incorporate additional information as the reporting requirements among corporations become more stringent. So we have that aspect as well. And those are and I guess the final thing I would say about it is that the quantitative scoring system is really, it's an identification tool. So we have a universe of some 5,000 stocks, and perhaps 2,500 of those stocks pass our Islamic screens. And of that, perhaps 1,100 also pass the Shariah screens. And so we have this universe of companies that this quantitative system identifies, but by no means is it a selection tool. We don't say, oh, our ESG scoring system gives us an A, we can buy it. Not even close. We're still going to go and do a really deep dive on this company in a fundamental way to determine if it's a viable investment candidate.
Okay, I like the point that you mentioned earlier. If we don't comply, you're out. So that's from your side. So do you basically participate, or do you get involved in terms of educating the other party to basically bringing them back into your investment, as in like creating awareness on the importance of the ESG environmental discussing? Yeah, so to not be involved in actually educating their clients.
Yeah, our clients, yes. Our investments, not so much. We're in a very different position from QOP, and I can certainly understand why Rizal would they would take the approach that was described, but we're very small relative to American fund management. The Apple is the largest position in the Amana Growth Fund that I manage, and my position in Apple is maybe 1/10 of 1% of the size of Apple, probably not even that much. So they don't really care what I have to say. So we've taken the approach that, there are companies out there like the California Employees Pension Fund and big firms with hundreds of billions of dollars under management. They can have the discussion. Our position is going to be that if you violate our requirements, we're just going to divest, and we'll let somebody else convince you to be a better actor in the future. Now, that said, we do talk with many of our companies, with our investments, and if there is a specific ESG issue that's not a disqualifying one, but is something that we would like to see them do a little better, we'll certainly bring that up. We'll say, hey, maybe you should think about this. This would be good if you reported these numbers, or, let's talk about your board a little bit. We'll have those discussions. But if there's someone who's violated, particularly in the area of governance, which was mentioned earlier, that's something it's just disqualifying for being a part of the portfolio. I guess one of the things I was saying, one last thing I would say about that is because these things almost never happen in isolation. So you take, for example, not that we were invested in it, but take Wells Fargo, for example, American Bank. First you had the false accounts, and then it was just a litany of one corrupt practice after another that went on for 2 years. So we don't want to be exposed to that type of event either.
If I can add to Scott's good point, I also noticed that normally if there are issues with the governance pillar, it will also affect the social and environmental pillar, because then, for example, their disclosure, whether it's authentic, is being questioned, whether they're doing greenwashing. So the governance pillar is, like what I mentioned and also what Scott mentioned, very important, because it can really affect the company's credibility and also their overall practices. Just to add, thank you.
Okay. Yeah. Speaking of that, you're saying that you talk about then there's any non-governance in terms of financial reporting, non-governance in terms of Shariah compliance, this kind of thing. And back to first answer earlier, you're saying that you have a list of the do's and don'ts. So do you actually participate or take part in terms of educating your investing companies? Because you're saying that, okay, fine, as long as you comply with all this, we'll invest in you. Otherwise, I'm sorry. So apart from just pushing them off, so do you actually guide them and, how should I say, create the awareness in terms of the importance of this ESG, not so much of the environment, also in terms of governance, because that's governance is also an issue. Yeah.
Is that a question for me? Sorry, just clarify.
Yes.
Okay, yeah. Good point.
Because I think
sure.
Scott is different in the sense that because they are more asset management. Your case, because you are very particular in terms of investing companies.
Yeah, it's a very good question. I was looking forward to that question actually. So to answer your question, from my observation, for example, the public listed companies, the bigger companies tend to be well aware of what needs to be measured, what do they need to put in place. The smaller companies might not have the sufficient number of resources, might not have the expertise. Hence, we find that, as what I mentioned earlier, one size fits all approach can't be adopted. So when we engage with smaller companies, we need to provide with more detailed guidance. But having said that, on a positive note, I noticed since we started in 2008 compared to then, a lot of the companies are very keen to adopt acceptable ESG practices. But this is where, as a government-linked investment company, we can provide the bridge between the government, which is including the regulators, and also the capital market. So to achieve this, what we've done is we've participated in committees involving the regulators before they come out with policies and guidelines. for us to give a practical approach as to what are the constraints, what are the issues that the PLCs are facing. And because we've been involved since the early stage, since the drafting stage, we are very well aware and we can convey this to the PLCs even better. So it's always interesting to engage with smaller companies because there's more to be conveyed, there's more rooms for improvements as compared to the larger ones which are already established. I hope that answers the question.
Well, but again, if you're talking about small companies, I mean, the cost will always be an issue.
Yeah. Yeah, but like what I mentioned, it's true. That is always the initial concern that they have. But they have seen the effect of, for example, their products being withheld by the export market. How they need to factor this in because ESG practices can have serious financial repercussions. So as and when there's more awareness, as and when other institutional investors also speak the same language and also share the same concern, because for us, the concern is two-pronged, financial and also reputational. We don't want to be associated with companies that practice poor ESG, even though they have cost limitations. But recent cases have shown that if they do not invest in ESG, the cost on their share price and also on their products can be very, very significant.
Okay, that's very interesting. Okay, I like to come back to Scott. Okay, let's say if we look at China, what is actually Satuna's biggest concern from ESG share perspective, and how do you actually position your investment on the China market? So how do you see that, Chama?
We, a year ago, decided that we did not want to have any direct investments in China.
Okay.
And so our view on China is really governance related. I think one of the issues that caused us to start looking at this in a more critical light was when Jack Ma made his speech about Chinese financial regulators, and subsequently the listing of Ant Financial being spun out from Alibaba was canceled by the government. And Jack Ma suddenly wasn't seen anywhere. He seemed to have disappeared under some sort of house arrest for some period of time. And it became quite clear, and it had been developing this way, but it came quite clear that there had been a significant change in the approach of the Chinese government towards private industry and more in favor of state-owned enterprises and the like. And so that's a tremendously important governance issue. I mean, governance is important at the corporate level, but it's also important at the national level if companies aren't able to conduct their business in a rational fashion. The another issue that around the same time was, of course, becoming more and more important was the treatment of the Muslim minority in Xinjiang, the Uyghurs in the western part of the country. And it became quite clear that China was engaging in I'm not exactly sure what the word is, but by establishing these camps and detaining people and forcing them to work in factories and punishing families of Uyghurs who were living overseas and speaking out about this treatment, it was clearly a significant violation, not only of what we would consider appropriate governance, but certainly from an ESG perspective, the social aspect of it was indefensible. And so you had issues. You had issues of how the government was approaching business, how the government was approaching its own people, particularly the Muslim minority, and those really just caused us to pull back. And there were also significant corporate issues. I mean, it seemed like all the three-legged stool, all three of the legs were pretty shaky. So you had a lot of aspect, you have a lot of examples of Chinese companies engaged in malfeasance as well. Luckin Coffee is probably the most well-known one, which was interesting because I went when I happened to be in China in late 2019, early 2020. It was not me who brought COVID outside of China, but I went to a couple of Luckin Coffee shops, and I'd been reading reports about how their business was booming, and Starbucks was going to be. They were old hat. Starbucks was over in China, which was important to me because we owned Starbucks in one of my funds, and so I went to these Luckin Coffee shops, and they were ghost towns. Nobody was in there, and came back to America and said, "This thing is not. This is not real. What's happening?" And then, lo and behold, about a month later, it went bankrupt because they've been falsifying accounts for years on end. And we've seen the same thing in the property market. That's been a significant issue. So I know that's a very long introduction to what's a pretty simple question, but we are avoiding China, and we don't, it's got excessive debt. The Xi Jinping's third term, in our view, is not a good indicator of the future outlook for the economy there. And the geopolitical tensions are something that can't be ignored. We think it's a significant risk that a slowdown in economic progress. We saw, I think, a 3% GDP figure was the most recent that wasn't released until after the CCP National Conference. That a slowdown in economic activity can potentially generate some unhappiness among the populace, and that Xi Jinping may decide a good way to distract from that is to engage in Taiwan. And so we see significant geopolitical risks there over the next several years, and are not directly invested, and are looking very, very closely at our indirect investments, companies that rely on China as either a market or as a source of production.
Thank you very much. What about Kwab? Do you have this concern as well in any of your investor companies abroad?
Investing companies abroad, we look at the main concern is the treatment of foreign workers, and also their supply chain issues. So this is where, for example, for Kwab, we have an office located in UK, which looks at the European market. So number one, it enables them to have a hands-on approach to the market, and also is good for capacity building. So we do have overseas investments, and it is certainly one area for us to generate good income. Thanks.
Okay, I wish to remind the members of the floor, if you have any questions, you can actually put it in the Q&A box. Okay, I think in the interest of time, to wrap up this session from the practitioner's perspective, what is actually the outlook of the Shariah compliant ESG in the next maybe 3 to 5 years in terms of growth of funds? Maybe you can start with Scott.
I wish I knew what the outlook for the next 3 to 5 years was.
Maybe they have a
yeah, I mean, I guess it's a key aspect of our approach is we really don't think a lot about that. I mean, we certainly think about the sort of geopolitical risk, as I was just discussing a moment ago, but we don't think too much about what is the outlook for the market or our funds. We really try to focus on our companies and all those issues, and just hope the business will take care of itself. There's so many uncertainties, whether it's related to geopolitical issues with Russia, Ukraine, China, Taiwan, or whether it's climate change that is becoming a greater and greater issue and having a larger impact on economic activity. I mean, certainly if we were sitting here 3 years ago, how would anybody's have predictions turned out? I think there's going to be a global pandemic. Probably not. So yeah, I really don't have a strong view on that. I mean, we feel good about our own company and our own funds because we have been performing quite well. We are seeing inflows, and we're looking at expanding our business. And we believe that the Shariah guidelines and the ESG provide a framework for us to continue to provide good performance going forward, and ultimately that'll be the determining factor.
Yes, result.
Hi. To recap the 2 points I mentioned earlier, Shariah and sustainability have common principles and they are complementary in nature. And
Yes.
based on what I mentioned, as when more and more asset owners integrate ESG, Shariah will be looked at one source for them to put their investments in. And further to that, there'll be investors would want to manage our financial and reputational risk. So this will have more prominence moving forward. And globally, from what the data I've gotten so far, ESG bond issuance broke the 1 trillion mark in 2021. This was after growing at 70% annually on average since 2019. And sustainability bond also surged, fueled by COVID measures. So I think the pandemic has increased the demand for sustainability bond. It slowed down because of the economic conditions and was only US 430 billion in the first half of 2022. Whereas green and sustainability sukuk totaled 4.4 billion in the same period. However, sukuk as compared to ESG bond, sukuk is only 1%. So I think moving forward, there will be an increase in demand for such investment.
So when you say about sukuk, so are you referring to the ESG sukuk or you're referring to the general sukuk per se?
It's the ESG sukuk, the green and sustainability sukuk.
So based on both of your prediction or your perception or your how you look at moving forward, I think in the next 3 to 5 years, so ESG investing is no longer something new. It'll be like a norm for this industry, right?
Yeah, I mentioned about 3 years ago that it will become mainstream. And personally, I think the pandemic has fast-tracked ESG to become mainstream for better integration, because people have seen the effect of the social and also the environmental pillar. They see the effect of it has on the supply chain, direct financial risk. And also, if this is the effect of the pandemic, imagine the effect of climate change will be even more devastating. Hence, it's ramped up the need for more ESG investments, ramped up the demand for more ESG investments as investors and also the businesses look at it beyond just profitability. They have also started to look at people and planet.
Okay, I think the audience, having heard both of your answers, I've got a question here. You're saying that yes, it's a positive outlook, and there's a possibility that ESG investing would be in the mainstream kind of thing. The question is, what about the enabling environment? Do you think that we are ready for that, or maybe Kwok can give from the Malaysian perspective, and Scott can give on the global perspective? Do we have the existing environment?
Yeah, if I can start first, for Malaysia at least, I have to applaud the regulators, Bank Negara, Securities Commission, Bursa Malaysia for coming up with various policies and guidelines. And specifically for Bursa Malaysia, they've gone beyond policies and guidelines. They've actually come up with guidebooks. For example, guidebooks on how they can integrate environmental into their business practices, how they can improve on their disclosure. And we've also had direct engagements with Bursa Malaysia. And for Co-op, we've been appointed as one of the champions, to convey this to the public listed companies. So the environment has certainly evolved. And there seems to be a better support ecosystem within the whole community. And even among the asset owners, even among the institutional investors, there are more joint collaborations whereby we don't just engage with the investing companies on our own, but we engage with them collectively. With that, with our large shareholding collectively, we are able to assert more influence. Thanks.
Okay. Scott.
Yeah, I would say that the enabling environment in the United States is quite problematic. We have one half of the political spectrum which refuses to accept the reality of climate change. and refuses to accept the utility of ESG. And so you've had specific states such as Texas and Florida that have specifically prevented their state pension funds from taking ESG factors into account. Now, this is really quite incredible from the perspective that Texas and Florida are probably two of the most vulnerable states in America to climate change. Florida will be underwater and Texas will be too hot to live in. And it's also self-defeating from the perspective that when you exclude large managers from, for example, participating in municipal bond issuance or other general fund financial support because they have ESG activities, you end up paying higher interest rates, or you end up having to pay more to raise money for the states. And that's been documented quite clearly with those specific, not just those two states, but a number of other states have adopted similar rules. And so I guess the good news is that at this point, it's really restricted to individual states. But who knows what will happen in 2024. Certainly the Trump administration was aggressively engaged in trying to remove ESG from as a legitimate consideration in investments, and that could come back. So I'm very sorry to say that the political environment in the United States is a significant risk for future ESG investment.
Would you be able to share the environment other than the United States? Maybe based on experience, maybe based on exposure, maybe.
I think every other country in the world is probably fine and rational. Brazil was certainly a country that was providing that was creating some difficulties, and there was a lot of deforestation under Bolsonaro, and that continues to be a problem. But since he lost and Lulu won the election, certainly that'll become a focus for them again. So if I look around the world, I see countries that have difficulty adapting to ESG because of their own financial situation. And I think that there have been some very, very relevant discussions raised at COP27 with regard to the responsibility for the developed countries to support not only the mitigation, but also the adaptation and the ability to deal with climate change effects for smaller and lesser developed countries. I mean, we've seen what's happened to Pakistan with the floods this year. You look at some place like the Maldives. I mean, they're literally at risk of disappearing. And so the developed countries, I think, bear a tremendous responsibility for addressing those issues. But I do see it being outside of the United States. I do see it being taken seriously, particularly in Europe. If anything, the Ukrainian war has demonstrated the risks of relying upon an unreliable partner, and also the risks of being reliant upon fossil fuels. I mean, it's something that you don't have of your own, so you have to bring it in from some other country. Better off to develop alternative sources.
Okay, thank you very much. I think we're about to end this session. So on behalf of the organizing committee, I'd like to thank both Mr. Scott and Rizal for being able to be with us, to share your thoughts and to share your experience. And, so on that note, thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much.